how to evaluate performance of a business or profitability of a business from the perspective of the people who have given capital to the business. There are four things that you can do to find out performance of a business from the perspective of the capital provider. What are the ratios that you calculate? You calculate four ratios. Ratio number 1 is earning per share. Ratio number 2 is cash earning per share. Ratio number 3, return on equity. And ratio number 4, return on capital employed. Now the question is, how to calculate these ratios? How to calculate these ratios? So you will calculate earning per share. The first ratio that you calculate is earning per share. How do you calculate earning per share? Take the figure of profit after tax or earning after tax, both mean the same thing. PAT you call it, or you call it EAT, both mean the same things, and divide this number by the number of shares of the company, number of shares, number of equity shares of the company, and this will give you your earning per share. And remember, in case अगर आपकी कंपनी में प्रेफरेंस शेयर कैपिटल भी है तो फिर आपको ये जो फॉर्मूला है थोड़ा सा मॉडिफाई करना पड़ेगा. और क्या मॉडिफिकेशन करेंगे? मॉडिफिकेशन आप ये करेंगे कि फ्रॉम द फिगर ऑफ अर्निंग आफ्टर टैक्स or profit after tax, you will minus the amount of dividend that may be payable on preference share capital, and so net profit minus the dividend on preference share capital, what remains, that is what you will take in the numerator, and denominator of course will remain the same, and that is your number of shares. How would you calculate the second ratio, which is cash earning per share? So again, cash earning per share gives you an idea as to how much return the company is earning on every share. How much return the company is earning on every share, that is what you will need to do. So what do? You instead of taking profit after tax in the numerator, you will take cash profit in the numerator. And how do you convert the figure of profit after tax into cash profit? You will do so by adding to the figure of profit after tax. You will add two more items, and that is number 1 is depreciation and number 2 is amortization, if there is any in your business. So when you add these three figures, it will become your cash profit. So when you divide the cash profit by the number of shares, what you will get? You will get the second KPI, and that is your cash earning per share. And this is how you will calculate. Now please remember once again, in case if your business is also having preference share capital, you will need to again slightly modify this ratio. And how would you modify this ratio? You will modify this ratio by, from this total, you will need to minus the dividend, amount of dividend on preference share capital, and divided by the number of shares, and again what you get is your cash earning per share in case if your business is having preference share capital also. So this is how you will calculate the earning per share ratio and the cash earning per share ratio. How would you calculate the third ratio that you can calculate to evaluate performance of a business from the perspective of capital providers? And how would you do that? So you will calculate the third ratio, which is return on equity. And how do you calculate this ratio? So you will take EAT, earning after tax, divided by the you will divide the earning after tax, and you will divide it by the net worth of the company or equity of the company into 100, and this will give you your return on equity. कैसे मालूम करेंगे कि ये रिटर्न ऑन इक्विटी बढ़िया है कि बढ़िया नहीं है? उसके 4 तरीके हैं. पहला तरीका ये है कि अपनी रिटर्न ऑन इक्विटी को अपने बजटेड फिगर से कंपेयर करिए, और दूसरा तरीका ये है कि अपने ये साल की रिटर्न ऑन इक्विटी को लास्ट ईयर की रिटर्न ऑन इक्विटी से कंपेयर करिए. तीसरा तरीका ये है आपके बिजनेस की रिटर्न ऑन इक्विटी का कंपैरिजन आपके कॉम्पिटिटर्स के रिटर्न ऑन इक्विटी के रेशो से करिए. और चौथा ये है कि अगर आपकी इंडस्ट्री की कुछ नॉर्म्स हैं रिटर्न ऑन इक्विटी की, which are based on the combined figure of all the companies in your industry, उससे कंपेयर करिए, and that will give you an idea as to what kind of return your business is giving to the equity shareholders by way of return on equity. The fourth ratio that you calculate from the perspective to find out as to what kind of performance your business has as far as the people who have given you capital. And remember, it is not only the equity shareholders who give you the capital, lenders also give you the capital. The only difference is lenders give you capital by way of debt, shareholders give you capital by way of equity. But ultimately both of them are giving capital to the business. So the fourth ratio that you can calculate to find out as to how is the performance of the business, and that you can do by calculating something which is known as return on capital employed, ROCE. It is also popularly known as ROCE, return on capital employed. How do you calculate return on capital employed? This of course is very simple. It is return divided by capital employed. Return divided by capital employed into 100. This gives you your return on capital employed. But how do you calculate? For calculating this ratio, the correct formula is take the figure of earning after tax of your business and add to this figure the interest that you would have paid on the long-term loans that you must have taken, and divided it by the amount of equity and the amount of debt put together into 100, and this will give you your return on capital employed. What this ratio tells you, what this ratio of return on equity tells you, this ratio of return on equity tells you as to, as a business, what kind of return you are giving to your capital providers. How do you figure it out, whether it is a good number or bad number? Once again, please remember, compare your return on capital employed with four numbers. Which are the four numbers? Number one, your budgeted return on capital employed, your return on capital employed of the last year, or your return on capital employed of your competitors, or return on capital employed norms as per your industry. So when you compare your return on capital employed with any of these four numbers, it will give you an idea as to how is your business providing return to the people who have given capital to your business. उम्मीद है आपको यह वीडियो पसंद आया होगा, और अगर आपको यह वीडियो पसंद आया है तो सबके साथ ज़रूर शेयर करिए और हमारे चैनल को सब्सक्राइब करिए, और सबके साथ में और अपनी जो फीडबैक है वो भी हमारे साथ में शेयर करिए। थैंक यू।